corrected with foreign equity index over the intermeeting period. Domestic equity index were quite volatile in late August and early September, 1 month ahead of the option implied volatility of the S&P 500 index reached levels last seen in 2011. Spreads on 10-year Treasury, 10-year triple B rated and speculative grade corporate bonds over compatible maturity Treasury securities widened slightly over the intermediate period. Let me kind of skip on here for time. Financial conditions in consumer credit markets remain generally accommodative, and performance of outstanding consumer loans were largely stable. Credit card balances expanded amidst gradual easing of lending standards. Students and auto loans continued to be broadly available, and even to borrow with subcredit scores. Delinquency rates on credit card loans, automobile loans stayed low. Very important there. Staff economic outlook. The U.S. economy forecast prepared by the staff in September meeting was a little weak on balance over the period prepared for June. The staff that consumer pricing inflation would remain down over the near term and more than in previous projections. Crude oil declines in the intermediate period. Principal view on current conditions of economic outlook in conjunction with the FOMC meeting. Members of the Board of Governors and Federal Reserve Bank presidents submitted their projections on likely outcomes of real growth in the employment rate 2015 through 18. The long-run projection represents each participant's assessment. In their decision, the economic situation outlook meeting participants viewed the information there. And let me just move on here. Inflation continues to run below expectation. Consumer spending was rising at a solid rate after a modest increase on Q1. Participants agree that labor market conditions have improved considerably since early in the year. Payroll employment has increased at a steady rate. Underutilization of labor resources has diminished along a number of dimensions. The unemployment rate has fallen to levels close to most participants' estimates. With a cumulative improvement in labor market conditions, most participants thought the underutilization of labor resources had substantially reduced, and a few of them expressed the view that underutilization has been eliminated. Not certain which world they were living in. Incoming information on wage and labor compensation including an especially low reading on employment cost index for Q2 showed no broad-based acceleration. A number of participants reported that some of their business contacts were experiencing labor shortages. We've seen that in the Midwest. I think I was reading an article in the restaurant sector, a low-paid sector. Various occupations in geographical areas resulting in upward pressure on wages. That should happen. Recent readings on the headline consumer price inflation reflect only small increases in core inflation. Participants continue to judge that a significant portion of the shortfall was a result of transitory effects of declines in oil prices, non-energy commodities. A few participants point out that since January, when steep drops in energy prices ended, core PCE prices have risen at an annual rate of 1.7%. Participants' discussion of potential impacts of recent economic and financial developments abroad for the U.S., a material slowdown in economic growth in China, and potential spillover to other economies. Many participants judge that the effects of these developments on domestic economic activity were likely to be small, but acknowledge that the risks they might restrain U.S. economic growth somewhat, in particular the appreciation of the of the dollar, appreciation of the dollar since mid 2014 was still a substantial drag. During their discussion of economic conditions and monetary policy, participants indicated that they did not see that changes in asset prices during the intermeeting period as bearing significant on their policy choices, except insofar as it affects the outlook for achieving the committee's macroeconomic objectives and the risks associated with that outlook. Many of them saw the likely effect of recent developments on the path of economic activity and inflation as small, transitory. Participants weighed in on a number of risks associated with timing of policy firming. Some participants were concerned that the downside risk to inflation could be realized if the target range for the Fed fund rate was increased before it was clear the economy would remain at the above trend pace. They also worried that such a premature tightening would erode the credibility of the committee's inflation objective, staying at below 2%. Committee action. In discussing monetary policy for the period ahead, the FOIC met in July, indicated that economic activity was expanding at a modest pace. Members agreed that labor market conditions have improved considerably. Well, that's so. Asserting whether economic conditions have improved sufficient to initiate affirming in the stance of policy, many members said that the improvement in the labor market conditions met or would soon meet one of the criterias. The committee would return to the 2% objective over the midterm has not increased, a large part because of global economic conditions. Other factors, the committee's assessment of inflation outlook were the expectation that influences of low energy prices and commodity prices on headline inflation would abate. And that has been around for a long period of time. The committee agreed to maintain a large range of federal fund rates at 0 to 1/4% and to reaffirm its post-meeting statement that the committee's decision about how long to maintain the current rate for federal fund rates would depend upon assessment of actual and expected progress towards the objective of 2%. In conclusion, the committee voted unanimously, directed the Federal Reserve Bank of New York until it instructed otherwise to execute transactions in that consistent with statutory mandate of the Federal Open Markets Committee, and to support continual progress toward maximum employment and price stability. The committee today affirms its view that the current 0 to 1/4% target for the federal fund rates remain appropriate in determining how long to maintain it. And voting for the action, Yellen voting against Jeffrey Locker. Locker's dissented because he believes that maintaining exceptionally low real interest rates was not appropriate for an economy with persistently strong consumption growth and tightening labor markets. That is the report there. And let me just check on the time. We may have to hold off on the Group of 30 report, depending on where we are in time. Okay, well, I just briefly highlight the Group of 30. Group of 30's mission is to deepen the understanding of international economic and financial issues, to explore the international repercussions of decisions taken in public and private sector, to examine the choices available to market participants and policy makers. Let me just move on here. It's a very, very long report, but we'll try to get to the conclusion of it here and all the working. Okay. The executive summary, almost from the beginning, over 3 centuries ago, the ultimate objective was central banks have been to support sustainable economic growth, through the pursuit of price stability and financial stability. In the immediate decade prior to 2007, 2009 economic and financial crisis, the Depression, in other words, the policy pendulums swung strongly towards favoring price stability with focus on relatively short term. The Great Moderation, a period of apparent relative economic calm and stability, occurred in advanced markets. That's what they call AME. The economic stability supported a theoretical view and a mindset that saw economies as being inherently self-sustaining and efficient in its allocation of scarce resources, something economists like to look at. The prevailing view, despite building evidence of underlying tensions and imbalance and the proliferation of localized economic and financial crisis, in hindsight, the economic calm obstructed a credit bubble that was growing and becoming precarious. The bubble collapsed. We all know about that. And let me get a little bit more of this. Despite response to the economic and financial crisis, central banks played an essential crisis management role, along with government central banks in major advanced economies reacted with vigor. Policy rates were reduced essentially to zero, that we know of as the record. In 2015, 8 years on, the corruption of the crisis, the central banking community still faces many difficulties and challenges as it's a survey exit strategy from current economic policy stances and grapples with possible midterm impacts. While the unconventional monetary policy is self-evident, the course of unintended consequences are not. The timing and further policy measurements will reveal the magnitude of such costs. In light of the crisis and substantial policy responses, important questions have risen as to the proper role, duties, and obligations of central bank. And this report seems to illuminate central banks' lessons from previous crisis periods, the crisis itself, and subsequent policy responses. The report finds while some of the early benefits held by central bankers need to be modified, there are key pillars that constitute the formation of central banking that must be maintained. The report identifies 3 principles and 10 key observations dealing with frameworks to manage and resolve crisis and crisis prevention. Key principles: long-term price stability is the most important contribution central banks can make to ensure strong, sustainable growth. 2, fostering economic stability should also be an important part of a central bank's mandate. 3, it's critical that the independence of central banks be maintained. While unconventional policies such as quantitative easing, off-balance sheet commitments, and forward guidance have played an important role in the management of recent crises, deep studies are needed to ascertain their long-term and overall benefits and unintended consequences. Framework for financial stability and crisis prevention. Central banks are primarily responsible to ensure the efficiency and stability of global payments and settlement system. Micro-prudential policy has a role to play in crisis prevention, especially in dealing with credit-supported booms, particularly in the housing sector, which they saw. Let me just get back up here, and we'll end this little situation here, because we pointed out there needs to be broad consensus that that flexible exchange rates are the best way to minimize the international repercussions of domestic monetary policy. Central banks must be transparent in explaining their policy actions. While macro-prudential policies are the preferred choice to address financial stability concerns, there is no consensus as to whether monetary policy should be used